You're listening to All Things Investing, the podcast that makes money talk simple, smart, and actionable. Whether you're just getting started or leveling up your portfolio, we've got you covered with tips, strategies, and no-fluff advice. Let's grow your wealth, one episode at a time.
If you wait until you're 35 to start investing, instead of starting at 25.
Assuming, a standard market return on just like $500 a month.
Right, exactly. That 10-year delay is going to cost you roughly $3 million.
Oh, wow.
Yeah, $3 million. You read that right. Waiting for the perfect time to get your finances in order. It literally comes with a $3 million price tag.
That is just, it's a staggering number to open with.
It really is. Welcome to the deep dive. Today, we're basically dismantling the illusion that building wealth requires some sort of insider knowledge or like a Wall Street pedigree.
Right, because that $3 million figure, it perfectly encapsulates the cost of information paralysis.
Yes, exactly.
The people listening right now, you likely already know you need to optimize your financial life. You understand the stakes.
Right. You should be doing something.
Exactly. But we see this exact scenario played out in one of our sources today, the Native's Money Guide.
Oh, the browser tab thing.
Yes. You have a browser tab open about Roth IRA conversions, another tab analyzing the expense ratios of like emerging market ETFs.
And maybe a third trying to decipher treasury yield curves or something.
Right. And you just sit there staring at your screen for 3 hours. The cognitive load maxes out and...
Close the window.
Exactly. You close the window without executing a single trade or transfer.
And that specific flavor of overwhelm is exactly what we're dissecting today. We have a really fascinating stack of financial roadmaps to synthesize for you.
Yeah, we're looking at the ATI 19-step guide, the Ramsey 7 baby steps, and some incredibly pragmatic frameworks from Impact Wealth and Native's Money.
And the through line across all of them, the central premise we're going to prove today is that a complex multi-step roadmap isn't actually paralyzing.
Right.
Not if you understand the underlying mechanics of the sequence. It's just a series of small sequential steps done consistently over time.
Sequence really is the operative word here.
Yeah.
What we find when we aggregate these roadmaps is that the order of operations carries far more weight than, the minute optimization of your asset allocation on day one.
Right. A 19-step plan is literally just one step, 19 times.
Exactly. But the behavioral trap that most intellectually curious people fall into is, the desire to leapfrog the foundation.
Oh, for sure.
They want to debate the merits of a small cap value tilt in their portfolio while they're actively carrying revolving consumer debt.
Which totally defies the basic laws of financial physics.
It really does.
So let's explore the mechanics of that foundation, because all of our sources universally agree on what they call step 0.
Or in the Ramsey framework, that would be baby steps 1 and 3.
Right, the emergency fund.
Yeah.
But I don't want to just say, save cash, because you, our audience, already knows that.
Yeah, we need to go deeper.
Exactly. I want to look at the structural fragility of an investment portfolio that lacks a liquidity buffer.
The Native's Money source actually provides a brilliant case study on this. It's a look at micro-scale sequence of returns risk.
Oh, the car transmission story.
Yes. So the author finally pulls the trigger on investing. They open the brokerage account, execute their buy orders, and deploy their capital into the market.
Huge win. They finally did it.
Right. But then 2 weeks later, their car transmission completely fails.
So brutal.
And because they bypassed step 0, because they didn't hold sufficient liquid cash, they're forced into a corner.
So they have to liquidate the assets they literally just bought.
Precisely. And of course, the market happens to be in a temporary dip that exact week.
Naturally.
So not only are they interrupting the compound growth process, they are crystallizing a paper loss into a permanent cash loss.
All just to pay a mechanic.
Exactly. And, the cash drag of an emergency fund, the fact that it's just sitting in a high-yield savings account losing slightly to inflation.
Right. Optimizers hate that.
They do. It's viewed as inefficient. But that inefficiency is actually an insurance premium. You pay it to protect your equities from forced liquidation.
That completely reframes the concept for me. It's not just rainy day money. It is a defensive moat around your compounding engine.
A moat. I like that.
Yeah, because you build this beautifully diversified portfolio, but without that moat, the first unexpected macroeconomic shock or personal crisis.
Like a medical billing error or a sudden layoff?
Right, or a major home repair. The first storm washes the whole thing away. It's like building a beautiful house on a foundation of sand.
It forces you to dismantle the very engine you're trying to build.
So the mathematical target across all the sources is eventually accumulating 3 to 6 months of baseline living expenses in cash.
And we should definitely define baseline here.
Good point.
This isn't like your current lifestyle overhead. This is the bare minimum capital required to keep the lights on, the calories consumed, and the shelter secured.
So no dining out budget included in that.
Exactly. If those essential operating costs are $3,000 a month, the structural moat needs to be between $9,000 and $18,000.
Got it.
Parked in a highly liquid, accessible vehicle like a high-yield savings account. You know, Ally, Marcus, SoFi.
But something entirely decoupled from your daily checking account, right?
Yes, exactly. You want to introduce a little bit of friction to accessing it.
Right. But I do have to push back on that target for a beginner, though.
Okay, go ahead.
If someone listening is operating with zero margin right now, telling them they need to stockpile $18,000 before they can even look at an index fund,
Yeah, it's intimidating.
it's going to induce the exact paralysis we are trying to cure.
Well, the sources anticipate that exact psychological barrier. The Ramsey roadmap specifically bifurcates this process.
Right. You don't start by chasing the 6-month figure.
Exactly. You start with baby step 1, which is a $1,000 starter fund. And the Native's Money Guide goes even more granular. They suggest people build that initial $1,000 in like $50 or $100 chunks.
Just to get the momentum going.
Right.
But mathematically speaking, what is $1,000 going to protect you against in 2026?
Fair question.
A major transmission repair easily clears $2,000. A minor emergency room visit blows way past $1,000. Isn't that starter fund, well, dangerously inadequate?
It is inadequate for a major systemic shock. Yes, absolutely.
Okay.
But you have to look at the behavioral purpose of that initial $1,000. It's designed to act as a tourniquet.
Oh, a tourniquet.
Yeah, it catches a blown tire, the unexpected dental copay, or, the minor appliance failure.
Right.
More importantly, it breaks the behavioral feedback loop of relying on revolving credit to solve unexpected friction.
That is huge.
Once you pay for a crisis in cash, the psychological shift is profound. You prove to yourself that you can insulate your life from chaos.
That makes a lot of sense. It's less about absolute financial security at that stage and more about, like you said, stopping the bleeding.
Exactly.
Because once that initial moat is dug and the car is back on the road, every single roadmap we looked at pivots aggressively toward liabilities.
The leaks in the plumbing.
Yes, we have to talk about consumer debt. And this is where our sources present a massive philosophical collision regarding exactly how to eliminate it.
It really is one of the most fascinating debates in personal finance because it pits mathematical optimization directly against behavioral economics.
So on one side of the ledger, we have the debt avalanche method.
Right, which is heavily favored by the ATI guide and Impact Wealth.
And their argument is rooted entirely in rational utility theory, right?
Entirely. You
Yeah.
analyze your debt, isolate the liability with the highest annual percentage rate.
Which is typically a credit card sitting between, 15 and 20-something%?
Usually 15 to 24%, yeah. And you direct all excess capital toward that specific balance while paying just the minimums on everything else.
The logic there is unassailable. I mean, if you carry a balance at 20% interest, allocating capital to eliminate that debt is functionally identical to earning a guaranteed, risk-free 20% return on your money.
It's mathematically perfect.
Since the broader equities market averages a historical return of around 10%, trying to invest while holding 20% debt is, it's mathematically equivalent to walking up a down escalator.
That's a great way to put it.
The avalanche method minimizes total interest paid and mathematically accelerates the timeline to zero debt.
It is bulletproof math. But then we introduced the Ramsey approach, known as the debt snowball.
Which essentially throws the calculator out the window.
Completely, the snowball method demands that you organize your debts purely by the size of the principal balance.
From smallest to largest.
Right, completely ignoring the interest rates. You attack the smallest balance first.
I have to say, when I first encountered this framework, I really struggled to justify it.
A lot of analytical people do.
Yeah, like if you have a $500 medical bill at 0% interest and a $5,000 credit card balance at 24%.
The snowball method tells you to pay off the 0% debt first.
Which is crazy.
Yeah.
From an optimization standpoint, you are willingly bleeding capital to interest charges.
You are. The snowball method will mathematically cost you more money and, on paper, takes slightly longer.
Right.
But here is where we have to transition from finance to psychology. If human beings were perfectly rational actors who maximize utility on a spreadsheet, the personal debt industry just wouldn't exist.
Oh, wow. That's a profound point.
We don't accumulate consumer debt because of a math error. We accumulate it due to behavioral impulses, lifestyle creeping, and instant gratification loop.
Quick break. If you're enjoying all things investing, be sure to follow, rate, and share this episode with a friend who needs to start investing smarter. Got questions? We might answer them in the next episode. Now, back to the show.
So the solution to a behavioral problem isn't necessarily a mathematical one.
Exactly.
It's a behavioral one.
We have to look at the research of people like Daniel Kahneman and Amos Tversky around loss aversion and motivation.
Right, behavioral economics.
The psychological friction of paying down a massive high-interest debt over 18 months with no visible milestone, it can cause severe fatigue.
The attrition rate must be incredibly high.
It is. People just give up. But the debt snowball engineers a series of rapid dopamine hits.
Oh, I see. So you clear that $500 medical bill in a month, and the line item literally vanishes from your life.
It's gone. Poof. And that quick victory alters your neurochemistry.
It builds, like, self-efficacy.
Yes, the belief in your own capacity to execute the plan, the momentum you gain from crossing liabilities off a list, physically changes your behavior.
You probably start finding extra money in your budget just to get the next hit of dopamine.
Exactly, just to clear the next smallest debt.
It leverages the exact same psychological loops as a video game.
Oh, that's interesting. How so?
Well, game designers don't drop you into the final boss fight on level 1, right? Because you would get crushed and never play again.
That's very true.
They give you low-stakes enemies to defeat so you can level up your skills and your confidence.
That is a phenomenal way to frame it. The avalanche approach might save you a few $100s in theoretical interest over the course of a year.
Right.
But the snowball approach might be the sole reason you don't abandon the entire endeavor in month 3.
So for the person listening, the mandate here is self-awareness.
Totally.
If you are deeply analytical, if you manage your life through pivot tables and seeing inefficient interest charges keeps you awake at night, execute the avalanche.
Let the math drive you.
Right. But if you are someone who thrives on momentum, who needs to cross items off a physical to-do list to feel progress, embrace the snowball.
The minor mathematical inefficiency is worth the behavioral adherence.
Adherence is everything. Because once you execute either strategy and the consumer debt is eradicated, the entire landscape of your financial life shifts.
The leaks are finally plugged.
Yes. Your Step Zero emergency fund is upgraded to that fully funded 3 to 6 month mode. Now your cash flow is liberated.
The defensive phase is over.
Exactly. And we transition into wealth accumulation. And this brings us to the accumulation anchor.
Right, step 4.
When we synthesize the roadmaps, specifically looking at Ramsey's baby step 4, they converge on a highly specific target.
Capturing 15% of your gross household income and deploying it into retirement vehicles.
Gross income being the operative term there.
Yeah.
Before taxes, before lifestyle expenses.
Which is intense. Now, for someone who has just spent 2 years grinding out of debt, pivoting to carving out 15% of their gross income, it can induce a profound sense of whiplash.
Let's contextualize that friction, because it's real.
Please do.
If a household is grossing $100,000 a year, 15% is $15,000 annually, or $1,250 a month.
Right.
If you are unaccustomed to that level of capital deployment, attempting to subtly extract that much liquidity from your monthly operating budget feels suffocating.
It triggers an immediate scarcity mindset.
It really does.
And if the execution feels like deprivation, you just won't sustain it. This is where the Native's Money Guide introduces a crucial modification for the accumulation phase.
Which one was that?
The concept of gradual scaling by intercepting lifestyle inflation.
Oh, yes. Let's dig deeply into lifestyle inflation, or hedonic adaptation, because the sources identify this as the silent assassin of almost every financial roadmap.
Hedonic adaptation is this observed psychological phenomenon where, as a person makes more money, their expectations and desires rise in tandem,
Right.
resulting in absolutely no permanent gain in happiness or financial security.
It's so insidious. You get a 10% raise at work. Initially, you feel flush with cash.
You feel rich.
Yeah. But within 3 months, you've absorbed that new income into your baseline.
Exactly. You upgraded your car lease, you switched from conventional to organic groceries, you booked a slightly nicer vacation.
The denominator of your lifestyle expands to consume the numerator of your income.
That is perfectly stated.
You are running on a treadmill, burning more energy, making more money, but your net worth trajectory remains totally flat.
Precisely. So the native's money strategy to reach that 15% anchor without triggering a scarcity mindset is to intercept your future capital before hedonic adaptation can take root.
Okay, so how does that work practically?
If you can only afford to deploy 6% of your income today, you start there. But the rule is, every time your income increases, an annual cost of living adjustment, a promotion, a bonus, you allocate at least half of that increase directly into your investment vehicles.
Oh, that is an incredibly elegant mechanical solution.
Isn't it?
So if I get a 4% raise, I bump my investment contribution rate up by 2%.
Right.
I still take home more absolute cash than I did last month. So I still get a psychological reward and a slight lifestyle bump.
Exactly.
But my wealth building engine just captured a massive influx of capital without me ever feeling the pinch of deprivation.
You're literally hacking your own behavioral wiring. You never miss money that never settled into your checking account.
That's brilliant.
And the same interception mechanics applies to variable income or side hustles too.
Right, because gig work is so common now.
Very common. The Native's Money Source outlines a pragmatic 1/3 framework for gig work or secondary income streams.
Okay, walk me through that.
Rather than allowing side hustle revenue to bleed into your general operating account, you ruthlessly partition it, 1/3 to taxes or savings.
Makes sense.
1/3 reinvested into the equipment or software to grow the hustle, and 1/3 aggressively deployed into your long-term equity portfolio.
It creates a closed-loop system where your secondary income automatically fuels your long-term accumulation without requiring daily willpower.
Exactly. But hitting that 15% target often creates a point of intense friction for individuals who are balancing competing multi-generational priorities.
I'm really glad you brought that up, because if I'm looking at this roadmap, I might have a fully funded emergency moat, zero debt, and free cash flow.
Right.
But I also have a 6-year-old child. And the compounding cost of higher education is terrifying.
It is.
My instinct is to divert capital away from my own retirement to aggressively fund their 529 plan right now.
Of course it is.
So why do all of these roadmaps, Ramsey in particular, militantly insist that step 4, retirement, must precede step 5, college funding?
It feels incredibly counterintuitive to parental instincts, right? Which are naturally self-sacrificing.
Very much so.
But the structural logic here is rooted in the mechanics of collateralized versus non-collateralized borrowing.
Okay, write that down.
When it comes to higher education, society has engineered an endless array of capital vehicles for your child. Federal loans, private grants, academic scholarships, work-study programs.
Because education is an asset that theoretically increases the future earning power of the borrower, so lenders are willing to underwrite it.
Exactly. But society has engineered absolutely zero capital vehicles for your retirement.
Oh, wow.
No bank on earth is going to issue you a non-collateralized loan to fund your groceries and property taxes when you are 75 years old and unable to generate active labor income.
Right. You cannot borrow for retirement.
You simply can't.
That distinction is chilling, honestly.
It is.
If you cannibalize your 15% retirement anchor to fund their tuition, you aren't actually giving them a gift. You are just deferring the liability.
Exactly.
You might pay for their 4-year degree, but you mathematically guarantee that you will become a financial burden on them in your 70s.
Right.
Securing your own financial independence is the ultimate intergenerational transfer of wealth because it buys them freedom from having to support you later.
It's a harsh reality, but it's an essential perspective shift.
Yeah.
So we lock in the 15% mandate for retirement. The immediate subsequent question is the mechanics of deployment.
Where does it go?
Exactly. The capital has been extracted from your paycheck. Now, through what specific vehicles do we deploy it?
Let's use the shopping cart analogy here to demystify the terminology, because this is where information paralysis spikes again.
Oh, the acronyms alone.
Right. A 401k, a 403b, an IRA.
These are not investments.
They are not. They are simply tax-advantaged shopping carts. Pushing a 401k cart down the aisle does not mean you have purchased any assets. It just means you're using a cart that the IRS has agreed to treat with special privileges.
That's a perfect analogy.
Our job is to pick the most efficient carts before we start pulling groceries off the shelf.
And the overarching order of operations for selecting these carts, synthesized across our entire stack of sources, follows a very rigid hierarchy.
What is it?
Employer match, then Roth, then traditional.
Let's break down the arbitrage of the employer match first, because skipping this is quite literally rejecting part of your compensation package.
That is exactly how it should be viewed. If an employer offers a match, for instance, they will match 50% of your contributions up to 6% of your gross salary.
Right.
That is not a perk. That is a component of your total compensation. If you do not deploy capital into that 401k cart to capture the match, you are voluntarily taking a pay cut.
To put the math on the table, if you earn $80,000, 6% is $4,800.
Yeah.
If your employer matches half of that, they're injecting $2,400 of pure risk-free capital into your portfolio.
It is an immediate, guaranteed 50% return on invested capital at the exact moment of execution.
Before the market even opens.
Exactly. You could be the worst investor in the world, picking terrible assets, and you still have a 50% buffer against your own incompetence.
That's amazing.
There is no hedge fund, no private equity firm, and no algorithmic trading strategy that can generate a guaranteed 50% return. You capture the match first, period.
Period. Okay, so the first card is full, the match is captured, but we haven't hit our 15% target yet.
Right.
The roadmaps then direct us to shift our capital into the second card, the Roth IRA. Why do these frameworks universally prefer the Roth architecture over the traditional IRA or traditional 401k?
It really comes down to modeling your current versus future tax liabilities and eliminating legislative risk.
Legislative risk.
Yeah. In a traditional cart, you execute the investment with pre-tax capital. You get a tax deduction today, which lowers your current adjusted gross income.
Right, which feels good now.
It does, and the capital grows tax deferred. But in the future, when you enter the distribution phase and start pulling capital out to live on, the IRS taxes every single dollar of principal and compound growth at your marginal income tax rate at that time.
And here is the variable we cannot control. We have absolutely no idea what marginal tax rates will be in 30 years.
None.
We are currently operating in a historically low tax environment. If the government raises taxes significantly to cover national deficits over the next 3 decades, a traditional cart leaves you totally exposed to that legislative risk.
Exactly. The Roth architecture flips the mechanics.
Okay.
You fund the Roth cart with post-tax capital. You have already paid the income tax on those dollars today. It hurts a little more in the present because you get no deduction.
Right.
But the trade-off is unparalleled. That capital compounds for 3 decades, and when you enter the distribution phase, every single dollar of growth is completely unconditionally tax-free.
So, to use a biological analogy,
Yeah.
You're paying taxes on the small bag of seeds you buy today, so that the IRS has absolutely no claim on the massive multi-million-dollar forest you harvest 30 years from now.
I love that. It is the ultimate defense against future tax hikes.
Wow.
So the mechanical flow for the listener is, step 1, deploy just enough capital into the workplace 401k to extract the maximum employer match.
Got it.
Step 2, redirect all remaining capital flow to max out a Roth IRA.
Okay.
Step 3, if you still haven't hit that 15% total threshold, you route the overflow back into your workplace 401k.
It's an incredibly efficient waterfall method for capital deployment. But I do want to clarify something regarding duration matching.
Okay, what's that?
These tax-advantaged retirement cards penalize you if you withdraw capital before age 59 and a half.
They do, usually a 10% penalty.
Right. What if the listener has medium-term liquidity needs? Say they're targeting a down payment for real estate in 36 months.
Yeah.
You don't want that locked up, right?
Absolutely not. Duration matching is critical. You never deploy capital into the equities market if your time horizon for needing that capital is under 5 years.
Why 5 years specifically?
The sequence of returns risk is just too high. A sudden bear market could wipe out your down payment right when you need to close on the property.
Right.
For a 36-month horizon, the Ramsey source is explicit. You utilize a money market account or short-term treasury bills.
So not a retirement card.
Exactly. The goal for short-term capital is not growth. It is capital preservation with a yield that simply tries to pace inflation.
Okay, so we have our tax-advantaged cards selected for the long term. The capital is flowing into them efficiently. Now we reach the final friction point.
We are standing in the grocery aisle.
Yes. The carts are empty, waiting for assets. We have to pick the actual investments.
And this is where the personal finance world splits into 2 fiercely opposed philosophical camps.
It gets heated.
It really does. But before we debate the philosophies, we must establish the baseline assets that populate these portfolios: equities and fixed income, or stocks and bonds.
And just to establish the risk mechanics here, when we hold equities, we are assuming the volatility of business ownership in exchange for the premium of long-term corporate growth.
Right.
When we hold bonds, we're assuming the position of the lender, trading away the upside of growth for the fixed certainty of yield and lower volatility.
Beautifully explained.
But regardless of how you mix those two asset classes, there is one universally agreed upon catastrophic error that every source warns against.
Individual security selection, stock picking.
Yes. The Natives Money piece has a really visceral anecdote about this.
Oh, the meme stock one.
Yes. The author, driven by, retail market exuberance, attempted to chase a momentum play on a specific meme stock. They truly believed they had an informational edge.
They almost always do.
Within months, the position suffered a 40% drawdown.
It is a statistical inevitability. When a retail investor attempts to pick individual equities, they're essentially taking on unsystematic risk.
Unsystematic risk.
Yeah. That's the risk that a specific CEO makes a bad decision, or a specific supply chain fails, or a specific sector faces regulatory crackdowns.
Things you can't predict.
Exactly. All of our sources mandate diversification as the only free lunch in finance. You must disperse that unsystematic risk across hundreds, if not thousands, of companies.
But exactly how we achieve that mass diversification is the great philosophical divide.
The great debate.
Let's look at philosophy A first, which is heavily championed by the ATI Guide, Impact Wealth, and Natives Money.
Right.
This is the doctrine of the efficient market hypothesis, executed through broad market index funds and ETFs.
The core thesis of Philosophy A, originally pioneered by Jack Bogle, is that markets are highly efficient at pricing information.
Okay.
Therefore, trying to hire a Wall Street manager to outsmart the collective intelligence of the global market is a fool's errand. Instead of paying someone to search for the proverbial needle in the haystack, an index fund simply buys the entire haystack.
The ATI Guide actually lays out the mechanics of a three-fund portfolio.
Yes, very classic.
You allocate a percentage of your capital to a total U.S. stock market index, a percentage to a total international index, and a percentage to a total bond market index.
It's so simple.
It is. You instantly own fractional shares of nearly every publicly traded company on the planet. But the true leverage of this philosophy isn't just the diversification.
No, it's the fees.
It is the absolute elimination of fee drag.
Fee drag is the parasite that hollows out compounding growth.
It really is.
Because an index fund is passively managed, it just runs an algorithm to track a predefined list of companies. The overhead is microscopic.
Like how microscopic?
The expense ratio on a broad U.S. index fund might be 3 basis points or 0.03% annually.
Let's contextualize that against active management. An actively managed mutual fund might charge an expense ratio of 1% or even 1.5%.
Which is huge.
But to a layman, a 1% fee sounds like a rounding error. Like, who cares about 1%?
The math cares deeply.
Yeah.
If you assume a gross market return of 8%, the index fund investor nets 7.97%. The active fund investor nets 7%.
Right.
Over a 40-year compounding horizon, that 1% annual fee doesn't just reduce your final balance by 1%.
Oh, no.
Due to the loss of compounded growth on the capital that was siphoned away as fees, it can consume 20 to 30% of your total potential portfolio value.
That is sickening.
You are sacrificing hundreds of thousands of dollars to pay the manager's salary.
That is the ironclad mathematical argument for philosophy A. Passive, low cost, capture the market average, and let time do the heavy lifting.
Exactly.
But then we have philosophy B, the Ramsey approach, which aggressively rejects the premise that you must settle for average market returns.
Philosophy B argues for the deployment of actively managed growth stock mutual funds. The thesis here is that while the majority of active managers do fail to beat the index after fees, a subset of highly skilled managers with long-term verifiable track records can generate alpha.
Returns that exceed the market average.
Right, making their higher expense ratios theoretically worth the cost.
And Ramsey prescribes a very rigid, evenly weighted asset allocation for this. He divides the capital into 4 quadrants.
Yes, 25% into growth and income funds, which target large cap, blue chip equities that offer stability and dividends.
Yeah, okay.
25% into growth funds, targeting mid-cap companies in their expansion phase.
Got it.
25% into aggressive growth, focusing on small-cap, highly volatile companies with massive upside potential. And 25% into international funds, providing geographic diversification against a U.S. domestic downturn.
It's important to note the behavioral guardrails inherent in Philosophy B. While an optimizer might completely scoff at the 1% fee of a mutual fund,
Right.
often that fee pays for a layer of friction between the investor and their own worst impulses.
Yes, the advisor acts as a buffer.
Exactly. An active fund manager might adjust the portfolio defensively during a macroeconomic shock, which might prevent the retail investor from panicking and liquidating everything to cash.
That is a critical point. If paying a 1% fee to an advisor or an active fund keeps you invested during a 30% market drawdown, that fee just paid for itself 10 times over compared to the passive investor who panicked, sold at the bottom, and locked in their losses.
Which perfectly transitions us to the execution layer. We have these two philosophies, but how does the listener actually interface with the market to buy these assets?
The nuts and bolts.
The sources contrast the DIY approach against the rise of robo-advisors.
This is essentially a debate over cognitive offloading.
Well,
If you go the DIY route through brokerages like Vanguard, Fidelity, or Schwab, you are manually executing the trades.
you're in the driver's seat.
You set up the transfers, you allocate the capital to your chosen index funds or mutual funds, and once a year, you manually rebalance the portfolio to maintain your desired risk profile.
Right. It maximizes cost efficiency, but requires ongoing cognitive engagement.
And the risk there is tinkering.
Oh, yeah.
Every time you log into the brokerage to rebalance, you are tempted to look at short-term performance, read a headline, and make an emotional adjustment.
Exactly. This is where robo-advisors like Betterment or Wealthfront provide a behavioral firewall.
A firewall, yeah.
You complete a risk assessment questionnaire, and their algorithms automatically construct an index-based portfolio for you.
It's totally hands-off.
They handle the dollar cost averaging, they automatically rebalance the assets when allocations drift, and they execute tax loss harvesting.
But they charge a management fee, usually around 25 basis points or 0.25% on top of the underlying fund fees.
Right. You are paying a small premium to entirely automate the execution.
For many investors, paying 25 basis points to remove their own flawed psychology from the equation is the highest ROI decision they can make.
So we have mapped the entire architecture. The emergency mode is funded. The debt is eradicated through the psychological momentum of the snowball, or the math of the avalanche.
Leaks are plugged.
We are capturing 15% of our gross income, routing it through the tax-optimized waterfall of the 401k match and the Roth IRA.
Check.
And we've deployed that capital into highly diversified, low-cost assets, either through a robo-advisor or manual execution.
We've built a flawless machine.
But a machine with no fuel is just a sculpture. The fuel for this entire architectural framework is time, combined with unwavering consistency.
Time is the secret sauce. Let's return to the staggering math we opened with. Because the mechanics of compound interest are notoriously difficult for the human brain to intuitively grasp.
We just don't think that way.
We don't. Our brains are wired for linear progression, not exponential curves.
The ATI guide uses a highly relatable micro example here. If you deploy just $300 a month,
Which is like $10 a day, the cost of a mediocre lunch. Exactly. And generate a conservative 7% annualized return over 30 years, the portfolio scales to roughly $366,000.
but the critical mechanic to highlight there is the ratio of principal to growth.
Oh, this is the best part.
You only actually deployed $108,000 of your own labor capital.
Right.
The remaining $258,000 was generated purely by the capital itself.
It's magic.
Your money went to work, earned a wage, and then that wage went to work.
And this is why the cost of delay is catastrophic. The curve of compound interest goes vertical in the final decades.
It's a hockey stick.
The Ramsey comparison illustrates this brutally. Person A starts at 25, deploying $500 a month at an 11% historical growth rate.
Okay.
Person B waits until they feel, quote-unquote, financially stable at 35 and does the exact same thing.
Just a 10-year difference.
At age 65, Person A has $4.3 million. Person B has $1.4 million.
10 years of delay costs nearly $3 million. You cannot earn enough labor income in your 50s to catch up to the compounding engine of a 25-year-old. You just can't.
You have to start where you are with what you have immediately.
Right, but we also have to address the psychological warfare of remaining in the market for 40 years. It is not a smooth upward trajectory.
Not at all. The volatility is the toll you pay for the premium of equity growth. The natives' money source shares the reality of this.
The 2020 crash.
Yes. In early 2020, as the global pandemic triggered an unprecedented macroeconomic shutdown, their portfolio suffered a 30% drawdown in a matter of weeks.
Let's analyze the neurobiology of that moment because it's intense.
It is.
When a retail investor logs into their brokerage and sees 30% of their net worth evaporated, the amygdala, the fear center of the brain, hijacks the prefrontal cortex.
Pure panic.
The biological imperative is to flee danger. And in financial terms, fleeing danger means liquidating the portfolio to cash to stop the bleeding.
It is the single most destructive action an investor can take, because a drawdown in the equities market is merely a paper loss. It is unrealized.
Right, it's just pixels on a screen until you sell.
The moment you execute a sell order during a panic, you crystallize that paper loss into a permanent destruction of capital.
You lock it in.
You ensure that when the market inevitably enters its recovery cycle, your capital is sitting on the sidelines, completely paralyzed.
This is why the mechanical strategy of dollar cost averaging is so profoundly effective. It is a structural defense against the amygdala.
Exactly. Dollar cost averaging is simply the automated deployment of a fixed dollar amount at a fixed interval, regardless of market conditions.
You invest $500 on the first of every month, no matter what.
Right. When the market is in a euphoric bull run and valuations are stretched, your $500 naturally buys fewer shares.
But when the macroeconomic shock hits and the market drops 30% and the financial media is screaming that the sky is falling,
your automated system executes anyway.
and because equity prices are severely depressed, your fixed $500 acquires significantly more shares.
You are systematically programmed to accumulate more assets when they're on sale, driving down your average cost basis over time.
It completely bypasses the need for emotional fortitude because the system is executing blindly.
It transforms a terrifying market crash into an aggressive accumulation opportunity.
It really does. When you pull all of these mechanics together, I am struck by an incredible realization.
What's that?
The actual process of building multi-generational wealth is staggeringly mundane.
It is aggressively boring.
We have the cinematic expectation that investing is high-stakes, adrenaline-fueled chaos.
Like the Wolf of Wall Street.
Exactly. Screaming on trading floors, timing the exact bottom of a commodity cycle. But the reality of actual wealth building is sitting at your kitchen table on a Tuesday evening, setting up a recurring ACH transfer into a Vanguard index fund, and then going to wash the dishes.
Good investing should resemble watching paint dry. If your portfolio is generating adrenaline, you are speculating, not investing.
So true.
To make this transition from paralysis to execution immediately actionable, the ATI source actually distills this entire philosophy into a 7-day operational sprint.
Let's run through that sprint. If you are listening to this and you want to dismantle the paralysis this week, here is the sequence.
Day 1. Conduct the audit. Map your baseline monthly operating expenses and define the target for your liquid emergency mode.
Day 2. Confront the liabilities. List every consumer debt. Select either the mathematical optimization of the avalanche or the behavioral momentum of the snowball and automate the payments.
Day 3. Capture the arbitrage. Interface with your employer's HR portal and configure your 401k contributions to instantly capture every dollar of the company match.
Day 4. Architect the tax defense. Open the Roth IRA to shield your long-term compounding from future legislative tax risks.
Day 5. Select the assets. Decide if you are aligning with the passive efficiency of Philosophy A's index funds or the active management of Philosophy B.
Day 6.
Right.
Remove the human element. Automate every single capital transfer so that the deployment happens concurrently with your payroll before the capital can ever enter your discretionary checking account.
And Day 7. Calendar a quarterly review to simply monitor the automation. You don't look at it daily. You check the oil every 3 months.
That is the entire roadmap, synthesized.
And as we contextualize this massive framework, the most vital behavioral takeaway is that the pursuit of perfection will destroy your progress. Consistency is the only metric that matters.
Right, because life is entropic. The structural moat you built on day 1 might get drained in month 14 because the roof collapses and insurance denies the claim.
It happens all the time.
You might have to pause the 15% accumulation phase just to rebuild step 0.
And the psychological trap there is feeling like you have failed the roadmap, which leads to total abandonment.
Right, throwing in the towel.
Regressing a step is not failure. It is the roadmap absorbing the shock precisely as it was designed to do. You just identify your new coordinates on the map and execute the very next logical step to regain momentum.
We opened this deep dive examining the anxiety of staring at a bank balance, knowing action was required but feeling paralyzed by the complexity of the future.
It's a heavy burden.
We obsess over the terminal velocity of this compounding engine. We fixate on the spreadsheet, calculating whether we will cross the finish line at 65 with $2 million or $4 million.
We let the abstraction of a future number dictate our present anxiety.
Exactly. But I want you to consider a different framework as you close this deep dive. What if the most profound yield this financial roadmap generates has nothing to do with the terminal balance in your Roth IRA?
It's a great question.
What if the highest return on your invested capital is the psychological sovereignty you reclaim today?
That is the true alpha.
When you automate the mechanics of your financial life, when the debt is structurally contained, the liquidity mode is filled, and the compounding engine is running quietly in the background, you reclaim immense cognitive bandwidth.
You stop staring at the browser tabs.
You buy back the freedom to be entirely present in your own life, anchored by the quiet certainty that your future is mathematically secure. Thank you for taking this deep dive with us. We'll see you on the next one.
Thanks for tuning in to All Things Investing. Don't forget to subscribe so you never miss a tip that could boost your financial future. Follow us on TikTok, YouTube, and wherever you get your money advice. Until next time, keep investing in yourself. Financial disclaimer. The information provided on the All Things Investing podcast is for educational and informational purposes only. It is not intended as financial, investment, tax, or legal advice. Always do your own research and consult with a licensed financial advisor or other qualified professional before making any investment decisions. The views and opinions expressed are those of the host and guests, and do not constitute official recommendations. Investing involves risk, including the potential loss of principal. Past performance is not indicative of future results. By listening to this podcast, you agree that the host and associated parties are not responsible for any financial decisions you make based on the content provided.